Welcome back to our special show report card, where we are trying to size up FY16 and give you an idea of how FY17 might pan out for markets. I've been speaking with veteran fund manager Vibhav Kapoor of ILNFS and Christopher Palmer. Gentlemen, before I come and ask you your preferences for FY17, just a brief backdrop on India's macroeconomy and how it will perform in FY17. My colleague Ekta Batra has polled a few analysts and she's here with what FY17 might look like. Ekta, tell us.
Well, I'll start with the GDP data for FY17, where economists expect it to possibly improve to levels of around 7.7%. This compares to 7.2% that we clocked in FY15 and 7.5% to 7.6% that we're expected to close FY16 with. Now, in terms of the growth for GDP in FY17, it's expected to be led by the agri sector, which is predicated on an assumption of a normal monsoon. GVA2 likely to increase to levels of around 7.6%. Compare this to 7.1% in FY15. 7.3 to 7.4% that economists are assuming FY16 is what we'll close the year with. Now, in terms of the CPI data, it's expected to come in a little over 5% in terms of an average for FY17, and that would compare to 4.9% that we've averaged for the first 11 months of FY16, but it would be much better than that 6% that we've averaged in FY15. So overall, CPI expected to be subdued on account of stable crude prices as well as an assumption again of a normal monsoon.
Growth marginally better, inflation stable to marginally lower. We can't ask for a better trend, can we? Well, Christopher, now to come to the global flows. What would be your preferred markets globally, and what would be your preferred markets within the EM basket?
Well, I think the big change for emerging markets in this calendar year has been the Fed's change in its policy stance with regards to interest rates, and that's allowed currencies to reverse course. And that's very important for emerging markets because the stabilization of emerging markets and then later the rallies in emerging markets typically are led by currency rallies, and investors use this as an important signal for which markets to invest in. Having said that, there's plenty of headwinds for each of the individual markets out there in terms of lower growth and in some cases recession, in other cases like India still incipient inflation. Having said that, the parts of the world that we think that will react most positively to that US dollar story and that weaker US dollar are places like Southeast Asia, where the currencies will be able to stabilize and adjust. India could be a beneficiary of that as well, but also there are plenty of countries where we've seen tremendous currency pressure, like in Latin America as well, where once investors get a sense that that pressure on the currency is off, we will see more money coming into things like the carry trade, taking advantage of higher interest rates. Those first mover investors, they do tend to pull in other investors over time. India could be a beneficiary of this in 2016, simply because its currency, which had been under a lot of pressure with the others, will start to stabilize and potentially go up due to those still high Indian interest rates.
Okay. Well, the FII funds, both in equity and debt, have certainly been kinder in the last 4-5 weeks. But debt flows did hydrate the markets very well in 2015 and large part of FY16. Well, Vibhav, what would be your chosen sectors? Since you say you are expecting earnings growth to come, would it be economy-leaning sectors, cyclical sectors?
Yeah, certainly, because we are expecting a lot of the improvement to happen in the domestic economy. And therefore, I would expect the domestic-related and the cyclical sectors to perform better. Now, one thing I have here is I think the financials generally in India, the banking sector, and globally also the banking sector has been doing really badly. I think I expect that actually to start improving in another couple of months from now, maybe after this last quarter results are out. I expect the financials to bottom out. And partly it could be because actually I think interest rates in the US once June comes, actually may go up a little bit more than what the market thinks now. And also because commodity prices are stabilizing, that also helps a lot of international banks. And as far as the Indian banking sector is concerned, I think, with the RBI doing what it is in terms of cleaning out the NPAs, etc., you would probably see these stocks bottoming out somewhere in the next couple of months. And if you have a reasonable fall from current levels, I think it would be a great time to buy banks and other financial sector companies. So that's one sector which I believe is going to give you good returns going forward. And then, of course, the other cyclicals like automobiles. I expect a thrust on rural sector by the government, as well as if you have good monsoons. So FMCG sector, two-wheelers, these are the type of sectors which should do well.
Okay. I know this is always a difficult one, but Vibhav, can the Nifty give you, say, 10% returns in FY17, 15% in FY17?
Yeah, we would be looking at something like a level of somewhere around 8,700 by March 2017. So that's what, about 13-14% returns from current levels, which would roughly be in line with the increase in earnings which we are talking about, 14-15%. But it also implies that for the moment, since we've had a very strong run-up, probably the market needs to consolidate at current levels or maybe even pull back a little bit from here, because the full year is still there. There is still a lot of uncertainty. We have still to see the monsoons and the earnings growth start to come in. So maybe markets is just starting to run a little bit ahead of themselves. They need to consolidate a little bit, and then, of course, I think they would be ready to go up further.
Okay, so you will buy on dips. Christopher, there are two crucial questions which an Indian investor will want to know from a person like you who sits with, who has a global perch. One, how many rate hikes do you expect from the Fed? And two, more importantly, actually, where might you see crude prices, for instance? One would like a view on all commodity prices, but crude, would it straddle $40, straddle $50, or straddle $30?
Well, different levels of crude prices are going to impact India in different ways. I think right now, in terms of the crude price and investor perception of risk in emerging markets, as long as we're lifting off of some of those levels we saw in the last couple of months, particularly that crucial $25 to $30 level for oil, where in fact many economies are in deep trouble. As we lift out of there, investor perception of risk drops. That's good for India. We don't want to see that oil price going up too rapidly, because that kind of headwind would be easily perceived as being bad for India. Where we see oil settling in this year is around $35 to $40 a barrel, but with relatively high volatility. So that's going to mean for investors that they're going to see weeks where oil might be up $2 or $3. People will extrapolate a trend from that, and that trend is going to very quickly fizzle out, because as we approach $40 a barrel, there is plenty of supply out there that can be released into markets, which is presently in storage. And that push and pull of the oil market is going to remain quite critical for investors' perceptions throughout the year. But with oil price below $40 a barrel, India is clearly seeing some benefits.
Okay. Well, we'll have to leave it at that because we're out of time. Christopher Palmer, Vibhav Kapoor, thank you very much for joining in and giving us a peep into FY17 and how that year might be. Just the Goldilocks level for crude, or so it seems, according to Christopher Palmer, and a good 14-15% earnings growth, and probably matching market returns from Vibhav Kapoor. That's the forecast. Thank you very much, gentlemen, for joining us in this special show. Thank you for watching Report Card FY16.